Hey folks, welcome back to Real Estate Investing Unmasked. Today, we're going to talk about ARMs. No, not those arms. So ARM, it stands for Adjustable Rate Mortgage. So what is it? An adjustable rate mortgage is a mortgage where over a certain period of time, your interest rate is fixed. Then, after so much time, then it makes an adjustment. And it keeps making adjustments on a very specific basis until the house is either paid off or until you refinance the property. So how does it work? In the early 2000s, everybody and their sister and brother were getting adjustable rate mortgages. And they were seen as a really evil mortgage. In reality, the adjustable rate mortgage is for certain people, and for other people it's not. In some cases, it's for people who can't afford a 30-year mortgage because the interest is higher. But that's not usually the best case to use it in. For many people, like farmers, it works great where they can have a lower payment over time. Over a specific time, they can have a lower payment, and they can make lump sums whenever their crops come in or whenever they make their windfall. The way adjustable rate mortgages work. Let's talk a little bit about how adjustable rate mortgages work. What are adjustable rate mortgages? You may have seen something say like a 5-1 ARM. What that means is for 5 years, the bank is going to lock in your rate, or the mortgage broker is going to lock in your rate for 5 years. That's the 5. The /1 means that one time every year, it's going to adjust the rate. So let's say, for instance, I get a 4% rate right now on a 5-1 or a 5-1 ARM. That means for the first 5 years, I'm locked in at 4%. But on the 5th year, they adjust my mortgage. They adjust my interest rate. Now, it could be the interest rates have gone down, so maybe I'll go down to 3.5%, and then they will lock me in for 1 year. The following year, the interest rates may have adjusted. Maybe I'm up to 5%. And then the next year, maybe I'm back down to 4.5%. The next year, maybe I'm down to 4%. So every year, the interest rate changes. There are some ways that those numbers get capped. For instance, a 5-1, a 5-year ARM, a 5-1 ARM is where you have your fixed rate for 5 years. Then after the 5 years, it adjusts every year. However, sometimes there's a cap. Now the caps could vary. You could have a cap that varies on what your payment will be. So for instance, if you have a payment that's locked in at no more than $1,000, that's the most your payment will be, then you will only have to pay $1,000. However, if the interest rate gets adjusted high enough that the amount of interest charged on your loan is more than the $1,000 that you're paying, then whatever you're not paying will actually be added on to the balance that you owe. And that actually compounds that interest and really puts you in a bad spot. So that's one cap. One cap is on how much you pay. Another cap they have is on how much interest it can be adjusted to. So for instance, you could have a 5-1 ARM where on the 5th year they adjust the rate, but let's say the interest rate jumps dramatically. So you're at 4% is what you locked it into for the 5 years, but now instead of 4%, the market rate after 5 years is now 7%. Well, if you have a cap of 2%, meaning it cannot increase more than 2%, total over the life of the loan, that means 6% is the highest you'll ever pay on that mortgage. It can go down, it can go up, but it can never go past the 6%. So that's another cap. Another cap they have, and sometimes they use two of these caps together, another cap they have is how much interest it can go up each year. For instance, a 5-1 ARM is one where after 5 years your interest is fixed and then it adjusts every year, but it cannot go up more than 1% per year. Your interest rate can't be adjusted more than 1% each year. What this does is it prevents you from being hit with that 3% jump that we talked about, going from 4% to 7%. Instead, it'd go from 4% to 5%. The following year, it'd go from 5% to 6%. The following year, it goes 6% to 7%. So it gives you some ability to earn more income to make up the difference of that 1% per year. What it also does, it also gives you the opportunity to make more principal payments onto your mortgage so that when the interest rate does go up, you can still maintain the same payment each month, but now more of it's going to be going toward interest, but at least your payment stays the same. So who are the adjustable rate mortgages for? For people who are business savvy, and you know, at least you have a plan, that you're going to stay in a house for no more than 5 years. You just know it. You know you're going to be there for, say, 2 years. Let's say you move to a location on a business for business, and you know you're only planning on being there for 2 years. Do you really need a 30-year mortgage? The answer is no, you probably don't need a 30-year mortgage. So 5-1, a 5 years locking in your mortgage with adjustments every year after the 5 years is probably not a bad idea if somebody's going to be there just for 2 or maybe 3 years. The average American over a long period of time has sold their house every 7 years. Now that has adjusted up and down depending on the situation with the housing economy, but for the most part, people stay in their houses only 7 years. So they also have 7-1 arms or 3-1 arms. There were a lot of people in 2003, 2004, 2005, a lot of builders that were offering arms where they would lock in a very low interest rate, say a 1% introductory interest rate for 1 year. Then after the 1 year, it would adjust up to the 3 or 4%, whatever the market rent was. So the way an adjustable rate mortgage works is you will have an index, and then the bank charges a margin on top of the index. So for instance, LIBOR, the London LIBOR, I'll put it down below. There's the LIBOR index, there's the Treasury index, or there's the COFI index. I call it COFI. So what a bank will do if they give you an adjustable rate mortgage is they will lock you in at one of those rates plus a little bit more. That little bit more is called margin. That's how they make their profit. They can borrow their overnight lending. They can borrow money at LIBOR or the Treasury or the COFI amount, and then they charge you that extra amount of money. It's good for the banks when it comes to adjustable rate mortgages to a degree, because what it does is it takes out some of the risk from them and puts the risk on you as the borrower, so that if the interest rates go up, the bank still makes money and you kind of lose more money. However, if the interest rates go down, the bank still has that locked in margin. Because the banks lose a little bit of that risk when they are lending you this money, they also give you a bonus up front. That bonus, it could be anywhere between 0.5% and 0.75% interest. And that can make a pretty big difference. It can make a difference on, say, a $200,000 mortgage. It could be the difference of about $7,000 to $8,000 over the 5-year period. So that can make a difference. If you were to make a 30-year amortized payment on a 5-1 arm over that 5-year period, if you were to do that, your principal balance would actually drop dramatically. Because you're going to have, even if it's just 0.75% of an interest, 0.75% of interest, that makes that big of a difference. The majority of your payment is going to be interest. So the lower the interest rate you can get at the beginning, the better off you are. I have always used a fixed interest rate for 30 years. That's what I have always done. However, I know many people, many investors, who know they're only going to be in the property for a couple of years, or plan on being in the property only for a couple of years, who will get an adjustable rate mortgage. It lowers down their liability up front, but allows them to appreciate the value of their property. If you're buying a property as a real estate investor for the appreciation, an ARM may not be a bad way to go. You will be able to hold onto the property with less carrying costs for those 5 years. Places like LA, San Francisco, Seattle, probably even New York would be my best bet. You're going to see appreciation in those areas. those are the areas where you could lock in a 5-1 ARM and lower your carrying costs for those properties while your equity builds. And then within a couple of years, sell the property, pull the equity, and put it into something else through a 1031 exchange or something else. Many people who have bought property in California, built up their equity position, sold the property, and moved somewhere else cheaper like Tennessee, Florida, Texas, places where the taxes are lower or non-existent for income tax, and bought themselves a very nice place, cash. The interest portion on an adjustable rate mortgage is based on two things. It is an index, whether it be LIBOR, COFI, or Treasury, and a margin, which is where the bank makes their money. Then the other part is the principal that you pay each payment. So when you have those three little chunks, that's what makes up your mortgage payment. A 5-1 ARM or a 3-1 ARM or a 7-1 ARM typically have a much lower interest rate than a 30-year mortgage. And the reason why is because you, as the borrower, are taking on risk. You're betting against the bank, saying that either the interest rate will stay the same, or it will go down or barely go up over the next few years. The bank is saying that if the interest rate does go up, they will still maintain that margin. So while the index goes up and down, the margin stays the same, so that the bank continues to make their money at a set rate. They know how much they're going to get back. So it works for the banks. They, in turn for that, they give you a discount on your mortgage. So instead of, say, a 4% interest right now, maybe they give you a 3.25% interest because you're doing a 5-1 ARM. Adjustable rate mortgages, or variable rate mortgages as they're called overseas, can have caps on them, placed to protect the consumer. Some of those caps include a cap on the payment, so that your payment never goes over a certain amount. They can have a cap on the interest rate, the interest rate of the life of the loan, or they could have a cap on the annual increase or monthly increase of the interest rate. Some are monthly, some are annually. It depends on the kind of mortgage that you have. Now, if you have an adjustment period every year, you need to make sure you're checking on your bank. Back in the 90s, when the government did studies on banks and making sure that they were charging the right amount of interest, many of them were not. Not most of them, but many were not. So if you know what date your rate is supposed to adjust, that's a pretty easy day for you to go find what index it's based on. You'll know your margin because it's inside your documentation, and you'll be able to see what your interest rate is going to be. You'll be able to track that. And if you have a set cap so that you know it's not going to increase more than 1% per year, it's not going to increase more than 2% per year, whatever your cap is, then you know what your safety net is. If you see the writing on the wall is that the interest rates are rising, well, then you can refinance your mortgage, lock it into a 30-year fixed, and you're good to go. If you have any questions about real estate investing in general, you have questions about mortgages, whether it be adjustable rate mortgages or something else about a mortgage, you just don't understand something, please just write a comment down below. Send me a question. If you don't want it to be seen, if you want it to be private, you can go to my website, watch Bob on youtube.com, and there you can contact me via email, and then I can create a YouTube video to show you or to answer your question as well. And if you want it just private, I can do that too. Hey guys, thanks for watching. If you liked it, give me a like. If you didn't like it, tap it twice, and then don't forget to subscribe. Thanks guys.